Joining us to break it all down is Tom Postilio and Mickey Conlon, real estate brokers at Compass. Good morning, gentlemen. Thank you for
joining us.
Sure.
Our pleasure.
Yes. So, Mickey, I do want to start with you. Talk to me about the biggest trends right now we're seeing as mortgage rates are hovering around the 6% level.
Sure, that's a great question because that question is top of mind for buyers and sellers. Sellers who are locked into lower rates from days gone by in the 2s and low 3s are reluctant to give those up. And they've been putting their plans on hold, their families' plans on hold. Similarly, buyers have been trying to game the market, trying to figure out when is the best time to buy, when are rates going to come down to 4.5% again. And the good and bad news is they're not going to. So what this does is it gives people permission to get back into the market, to fulfill their personal needs, and to get comfortable with rates that historically are in line with what's normal.
But I do want to point out that I like to say that you're sort of dating the interest rate, but buying the property. You could always refinance at any point in or when those rates do drop. Isn't that right, Tom?
100%, and that's a conversation that we have with our clients every day. Because as Mickey was saying, we have people literally waiting to have another child because they're just waiting for these rates to change. And as he said, this is the new norm. They are not changing. We're going to be at this 6, maybe a little bit below 6 if we get lucky, maybe in the upper 6s, but this is the new norm. And as we say, it's always a good time to buy if it makes sense. If you can afford it on a monthly basis, it is always a good time to own some real estate.
And speaking of rates, Mickey, I do want to come back to you. When it comes to the Federal Reserve and all eyes are on the Fed dropping interest rates, what do you think the impact could be on consumer behavior and affordability in the near term?
Also a great question. So for the past couple of years, our biggest concern, and the Fed's biggest concern, has been to cool down inflation. And that was feeling pretty good for a while, of course, in the past couple of months. When the September rate drop, everybody was sort of ebullient about this possibility that would translate into lower mortgage rates. But banks were already factoring in those reductions in lower rates since last July. So what we know now is that there is an increased fear of increased inflation in the coming year. And the Fed's announcement yesterday that there will not be as many rate cuts obviously sent the markets into a bit of turmoil. But it's not something to be incredibly frightened of. Again, we expect rates to stabilize in 2025, if not come down. So for those who really need to buy or sell, now's the time to do it before prices increase.
And Tom, Mickey brings up a good point. Obviously, there's a lot to look out for come 2025 with the new administration taking shape, anticipated 2 rate cuts. The Fed announced just yesterday. Talk to me about how consumers can navigate through this volatility and an uncertain market.
Get a good broker. Seriously, I mean, we often say, you wouldn't go into court without an attorney, would you? So it really is. It's tough terrain, and it is difficult to navigate. But we are cockeyed optimists. We have been for the last several years. It's been a tough time through COVID and the last few years with interest rates. But we're cautiously optimistic that 2025 is going to be a better space.
And Mickey, I do want to go back to you real quick as we are anticipating the new administration to take shape come January. How do you think his policies will impact the overall housing market, especially when it comes to tariffs and deregulation?
So we have some concerns about the incoming administration's housing policies. The 3 pillars of the policy to increase housing affordability are deregulation, mass deportation, and building on federal lands. Because federal lands are mostly in rural areas, that doesn't address the housing shortage in urban areas. Deregulation may come at a cost that we don't yet know, and the bigger question is that are those savings going to be passed on to consumers? And then there's mass deportation, which is not going to free up housing because those who are being deported don't own their homes. And furthermore, that effect on the labor market is going to be significant and could raise construction costs.
Tom, we have about 60 seconds left. What sort of regulations can be implemented by the new administration to strike sort of that perfect balance when it comes to housing affordability?
New regulations, I mean, in terms of building
Yes.
regulations, I mean,
Or even policies by the new administration?
well, tariffs. I don't believe we've talked about tariffs yet this morning, but I mean, that could negatively affect rates as well, because of the trickle down to consumers and higher costs. But again, we're remaining optimistic.
We're remaining optimistic. There's going to be a lot to look out for come 2025, but is there any key takeaways that you think the consumers should know as we round out 2024?
What I would say to consumers is, and again, this is buyers and sellers, because both are sitting on the fence. And if you sit on the fence long enough, not only are you going to miss out on a great opportunity before prices go up, but you'll just wind up with splinters. You're going to feel really bad when you look in the rearview mirror and realize you missed some great opportunities.
Well, thank you so much. It was a pleasure having you, Mickey, and thank you, Tom.
Thank you.